That was a terrific introduction, so I've got a lot to live up to while I'm up here at this podium here. I want to just obviously, I want to thank Jim Carpenter for obviously getting in touch with me last week and asking me to come speak to you all today. When he got in touch with me, he asked me, he said, hey, will you come give us an economic update? And I said, well, obviously this must not be a motivational meeting today, okay? So, I need the audience to help me do something before I get started, okay? Can you help me out? You ready? I need you to look to the left and to the right on the floor of your seats. Let me know if you see any kind of brown paper bags or plastic bags. You see anything to the left or the right? No? Perfect, perfect. Because the last time I did this presentation, they came out with tomatoes and eggs and rocks and all kinds of things. So I want to make sure that we're going to be protected today. All jokes aside, I'm definitely happy that I've got the opportunity to speak to ECS today. You guys are definitely at the center of a lot of this development that's going on. You guys recognize trends and see trends even a lot of times before we do. So definitely happy to have the opportunity to be before you today. And obviously happy to be gainfully employed this morning as well, seeing as we're not closing too many loans as of late. So I'm actually thinking about just jumping on the speaker circuit, and I can just go around and talk about how good it used to be, then I don't have to worry about closing any more loans. As we go through our presentation today, I really wanted to make it manageable so that I could give you guys a true understanding of what's happening in our markets. I'm going to spend my initial time just describing to you the events that have led us to the point where we are currently at. Then I'm going to touch on a little bit about where we are. I'm going to share some interesting statistics with you. And then I'm going to give you an overview on how I think we can get out of this mess that we're in. And I definitely want to save some time at the end for questions, because typically when I go out and do this presentation, that's where we really get the heart of the discussion going on. I know a lot of you are watching the Dow Jones drop, you're watching the S&P 500 crash, you're seeing credit markets freeze over, and you're just wondering, when is all this going to actually end? So I'm going to try to help you figure that out as best as I can today. But before I get started, I need you guys to recognize that what we are dealing with now is actually two separate crises. We are actually dealing with two separate crises. One actually started with a financial crisis, and now that's actually turning into an economic crisis that's starting to obviously engulf a lot of people from around the world. So what happened in our financial markets to create this crisis? To understand the root cause of the problem, you must understand the complicated process of securitization. Now, I'm going to give you a quick overview of that. I'm going to try to teach you as much as I can in 10 minutes about securitization. This is a structured finance process which involves the pooling and repackaging of cash flow producing financial assets into securities that are then sold to investors. Now, all assets can be securitized as long as they produce a cash flow. Now, when I used to work as a trader, we used to actually securitize auto loans, we securitized business notes, we securitized a variety of things. And in fact, at one time, if you keep up with the Wall Street Journal, James Brown even securitized his royalties and was able to sell them to a private equity group. And of course, they got into a big legal battle after that when he tried to reclaim them. So you can securitize anything that produces a cash flow. Now, to give you an example, imagine I went through this very room that we're in today and loaned each of you a sum of money. Now, this is going to take a wild imagination, okay? But imagine I actually went through the room and loaned each of you a little sum of money. And in exchange for the money that I gave you, you gave me an IOU, which promised that you would pay me at a specified date in the future. Now, what I could do is I could take all of those IOUs, I could package them into a bond, and I could sell them to investors so that way I can take my money now, and the investors who have the ability to wait will wait to get paid a little later. So it basically helps you to compete against the time value of money. Now, in spite of what the talking heads and the pundits on the news channels may tell you, the securitization process is not all about greedy bankers that were selling bad loans to make a profit. That's not exactly what it is. The process is actually efficient because it does allow our banks to replenish capital for additional real estate loans, which helps to grow the economy through a wider access to credit for developers, investors, and consumers. Now, typically, banks are structured so that they can only hold short-term loans because of the risks that are associated with the cost of their funding. So in other words, as deposit rates may rise, that could actually squeeze their profit margins if they have loans out in the market for too long of a time. So the securitization process helps these banks to continue to remove risk from the balance sheet so that they can continue to fuel the economy and keep growing their loan portfolios. So pension funds, insurance companies, and sovereign wealth funds are typically the buyers of these mortgage-backed assets. And that's mainly because they have a large sum of money that they can typically place into the market for a long period of time. So what happens is these loans, which are long-term in nature, they get matched up with long-term capital, and these guys are attracted to these securities because of the yield on them. The yield is obviously much greater than what you would get on a treasury. So you're probably sitting there and you're saying, okay, Algenon, if the process is so efficient, and it's so great, and it works so wonderfully, why are we dealing with a financial crisis today? Well, the attractiveness to a cheap credit environment led to excesses in the system. And that's at the very root of what's happening right here. We do have a shared responsibility here. Lenders did get a little over anxious with the amount of loans that they were creating. They got addicted to the ability to be able to sell these loans out in the secondary market. But we also cannot remove the responsibility of the very people that took out those loans. At the very center of this is massive financial illiteracy. People that did not quite know what they were signing up for, didn't quite know what they were getting into. So there is a shared responsibility there. Now, banks created off-balance sheet conduits named structured investment vehicles that took on leverage, and they bought the securities that were being created. Now, these institutions were doing something that, if you took investment 101, they would tell you to not do this, but they were actually issuing short-term loans out in the commercial paper markets. They would take that money and then buy these long-term dated securities. So all you guys are engineers in here, and I think you're fairly practical or logical. At least the guys at ECS are the ones I've worked with. So do you see the fundamental flaw? They're taking short-term money from the commercial paper markets, and then they're buying these long-term dated securities. Now, that strategy will work as long as you can continue to refinance your short-term obligations. But what started to happen is, as the underlying mortgages on these securities were defaulting, some of those money market investors that were loaning the money to these conduits, they finally woke up. And they said, hey, we're not going to keep loaning you money because we don't know if you can keep refinancing these short-term loans. So as they started to exit the marketplace and wouldn't loan any more money to these conduits had to be taken back on the balance sheet by these very large banks because they were running into funding issues. And we saw this, we witnessed this, because outstanding commercial paper in August of 2007 was $1.2 trillion. And it fell to under $800 billion by December 2007. That's a $400 billion contraction. That means money market investors flee the market, and that really started this credit system failure that we're now going through. Now, of course, the banks intended on selling these securities that were held by the conduits. So as they brought the securities back on the balance sheet, the idea was that, hey, we can still sell these loans out or sell these bonds out in the secondary market. But however, defaults did not decrease. They continued to rise. And as defaults continued to rise, it was causing these instruments to appear less and less attractive to fixed income investors. In other words, the market dried up and it became illiquid.